Hello, and I'd like to extend a very warm welcome to everyone who's joined us online for Henley and Partners' 16th Annual Global Citizenship Conference. My name is Juliet Foster, and it gives me great pleasure to introduce our panelists for this next session, which is focusing on the multiple benefits of real estate-linked investment migration options. Joining me online is Thomas Scott. Thomas is the Group Head of Real Estate at Henley and Partners. Nikki Greenberg is the Founder and Chief Innovation Officer at Real Estate of the Future, and Jordi Vilanova is the Vice President of Mercan Property Group in Portugal. A very good day to all of you, and thank you so much for joining us. Thomas, let me start with you first. Two questions, but rolled into one. Let's deal with the first part. Put this into context for me. What role does real estate play in investment migration?
Thank you, Juliet. Well, real estate has always been a popular asset class for global investors. Most high net worth individuals, it's likely that real estate has played a considerable part in their wealth generation, and that it probably holds a considerable percentage in their personal balance sheet. Real estate tends to be an asset class that high net worth individuals are familiar with and comfortable with. And as it's been widely reported, the investment migration space has become a lot more popular in recent years. So given that real estate is often a qualifying criteria for investment migration, it's perhaps not surprising that it is proven to be very popular with savvy investors.
And the second part of the question, really looking at the differences, if you like, between residency and citizenship programs. It often comes up in conversations along these lines, but what are the variations? How do they differ?
Well, there are numerous, and I suppose it's prudent to say that when one's comparing residency and citizenship programs, we're not comparing apples with apples, and programs and countries' laws and regulations against real estate do vary. But however, some of the key variants, I'll try and highlight some of them. The first and most obvious one is perhaps the minimum investment criteria. For example, in Spain, to qualify for the Spanish Golden Visa program, the minimum investment threshold is 500,000 euros, whereas in St. Kitts and Nevis, it's $200,000. Another variation in the 5 Caribbean programs that offers citizenship by investment, and as well actually in Montenegro, the property investment that the investor makes needs to be in a government-approved project. These are typically off-plan commercial buildings. They tend to have international brand and hotel operators affiliated with them, and they tend to be in locations where the government has earmarked for development and tourism growth. Another variation also linked to location can be even within a geographical location within a specific country. Using Montenegro as an example, if you invest in the north of Montenegro, the minimum investment threshold will be 250,000 euros. Whereas if you invested in the south and on the coast, and including the capital Podgorica, the minimum investment criteria would be 450,000 euros. So a variance even within one program. Another example where location also within a country can cause variance is Portugal. For the Golden Visa program in Portugal, no residential property in Lisbon, Porto, or the coast qualifies anymore. But a real estate investment to qualify in these regions must actually be a commercial property. But a little nuance here is in Portugal, there are low density areas that have been identified by the government and the program. And these are often referred to as the interior of Portugal, but actually residential property does qualify in an area like this. Whereas using another program as an example, Malta, there are no geographical restrictions or zones that limit where an investment can be. Another variation between programs is the type of ownership. For example, such programs as Grenada and also Portugal, they allow co-ownership of real estate, whereas programs such as Greece or Malta, it's a requirement that an investor must have a title deed. Probably one last variation, which I always like to highlight, is the holding period of a property. This is the minimum period of investment that an investor must hold the property before selling, because if they sold prior to that, ultimately it would jeopardize their residency or citizenship application. So by means of example, for holding period, St. Kitts and Nevis holding period for real estate might be 7 years. In Antigua, it would be 5 years. And an extreme example would be Montenegro, where you can actually sell your property in theory the following day that you've purchased it, because so it'd be the day after you receive title deed.
Sound advice there, Tom, but either which way, it all points to the needs of the different countries, but also the trends amongst the investors themselves. And I want to look at the trends in terms of movements, which is where you come into the conversation, Nikki, because if we look back to the early 2020s, well, we're still in the early 20s, but certainly the beginning, we saw many people leaving popular cities, for example, like New York and San Francisco, and perhaps surprisingly, they were heading for cities like Austin and Miami. As somebody who also looks at these trends through the eyes of a technologist, why did this happen? And can you see it having a lasting impact?
Thanks, Juliet. And it's been a very interesting few years in terms of internal movements in the US between markets. If we were talking about this 5 years ago, it would be a very, very different conversation. But where we are at the moment is, in a sense, we're in the eye of the storm, because there's so much that's happening in terms of movements around the country, the way that the luxury residential market's being impacted. So as you already identified, 2020 pandemic hit, people started shuffling around, and it happened for a few reasons. Very popular cities like New York, LA, San Francisco, Chicago, etc. A lot of people left. A lot of people left to their second homes, and a lot of people purchased second homes. There were a number of reasons for these moves. For some people, it was a matter of, well, we don't particularly want to be in a dense city at this time. If they didn't need to go into the office, did they really need to be there, or could they spend their time in their holiday home? Locations such as Miami did very well. The mountains, anywhere with a lake. People are like, well, I'm getting to spend time with my family. It doesn't have to be in an apartment block in a dense city. So, what we had is, a pandemic-led, flight from typical cities, but typically to a second home. People were also looking for more space. So some of the commuter towns did very well. There was a large rise in popularity in places like, Greenwich, Connecticut, Darien, Connecticut, New Jersey, where people could move out of the city, but still be kind of close, to where their workplaces were. And there was a trend that we saw all around the country. Then on the receiving end, as I said, cities like Miami did incredibly well. It has this lifestyle attribute. When I was meeting New Yorkers, when I came back here, a few months ago, you say like, oh, where do you live? Everyone's like, I live in New York and Miami. And of course, Miami, Texas as well, either low or no income tax. So that becomes very attractive for people to move to them. At the same time, some technology headquarters have moved into these other markets. Texas has received Oracle. They've put a headquarters there. Apple's building a $1 billion facility just outside of Austin. So what you're seeing is this kind of emergence of a lot of other cities that are doing very well and bringing in, a lot of wealth, a lot of talent, and just kind of a shaking up of things. So it's been quite an interesting time in the States at the moment. Now, in terms of the lasting impact, as I said, we're in the eye of the storm. So this whole question globally is around, will remote work continue to go on? And at the same time, with this, kind of looming uncertainty in the economy, everyone's thinking, well, is that going to be enough to drive people back to where their jobs are being held? So the thoughts around that is, on one hand, remote work is here to stay. You don't necessarily need to be in a capital city to keep holding onto your high paid job. But then on the other hand, New York is always going to have Wall Street. They're wanting to bring people back to the office, 5 days a week. You're always going to have, the lifestyle attributes of the big cities, this vibrancy. So I'm a big believer these big cities are going to go back. But at the same time, what we're seeing is that we've got these other cities like, Miami has also become a crypto hub. Don't get me started on crypto in light of the recent, crypto crash, but that's a conversation for another time. As I said, Texas with more technology hubs, etc. So while we have these main markets that are doing very well, that, have always had a lot of, great job opportunities. What we're also seeing is the secondary markets are also being increasingly attractive. So kind of, spreading the love around the country, I suppose you could say.
Within that answer, you did actually mention the luxury property end of things. And I'd like to address that with you by looking at some numbers. If we go to the 3 months to the end of August, for example, we found that the US luxury home sales actually fell by 28.1% compared to the same period a year ago. And again, a further context to that, it was the biggest decline since 2012. Now, these were the numbers from Redfin, the real estate corporation, and they're the biggest numbers, in fact, since they actually began gathering up this data. But it also eclipsed the 23.2% decrease, which we saw during the COVID-19 onslaught. So really the question has to be, what caused this decline? Because you think a luxury home, isn't that what every high net worth person actually wants? And does it perhaps suggest that now is the right time to buy? So being clever on how to play that market.
Absolutely. There's been a lot of volatility, and even just in recent months. Now, the volatility has been brought on by a lot of things. The markets are volatile. There was a huge amount of appreciation, especially at the start of the pandemic, when people were looking for larger and, more spacious homes, especially in certain markets. The Hamptons did incredibly well. Homes were selling out in a matter of hours. It was absolutely frenzied. So there's a correction happening there. And we know interest rates rises, sitting around 7% now. Uncertainty. There's a lot of environmental factors globally that's contributing to some instability in the real estate market. Now, America knows luxury. America knows luxury very well, and that's not going away. There are some of the most beautiful homes you've ever seen that really cater towards luxury market in, in the major cities, in secondary markets, in, places where people have, second homes. I've spent much of my career in luxury, so I will definitely be biased, spending it in new developments, especially. So when I say new developments, what I'm talking about is new build buildings, so off the plan, which are often quite popular for investors, from my understanding. Of course, we have some experts here that can answer questions on that. But the luxury market, you want to be able to see that decline because, cities like New York, San Francisco, LA, etc., Miami, they're always going to have the right attributes to be able to do better. So, buying a down market, there's beautiful options around, also beautiful options for second homes. There's actually also in this period, there's been an increase in the number of second homes that people have. And the National Association of Realtors actually found that 70% of people with a net worth over 5 million actually have a second home. And they saw an increase from, I believe it was from 23% to 32% or thereabouts within this 2020 period. So this trend towards not just having a primary residence, but having a secondary residence. And then, of course, the developers are catering towards this to make sure that there's beautiful properties scattered all around the country in major cities, but also in beautiful holiday locations like Aspen and other places. So worth thinking about.
Jordi, come into the conversation because Portugal was referenced in the beginning of this, in fact, by Thomas. But why do you think that Portugal itself is now the preferred destination as an investment immigration option in Europe? What is it doing right?
Yes, actually, we have 6 reasons why we think Portugal today is the preferred destination in Europe. The first one, with no doubt, is safety. So according to the rankings, today Portugal is the 3rd safest country in the world, being the 2 first countries, Scandinavian countries. So in the case of Portugal, what we also see as a result of that, that every time there is an incident in some part of the world, whether it's the US or in any other country, safety being the #1 driver, then Portugal is certainly one or the preferred destination. The second reason we have is the healthcare, free healthcare, which is obviously not only in Portugal, but all across Europe. But for investors that are looking for residency and citizenship, that's today one key driver, not only coming from North America, but coming from any other part of the world. And especially after the pandemic, because people have realized how important is healthcare in terms of their priorities. Education is #3. So not only there's free education in terms of primary and secondary schools, but when people look at the current tuition fees in Europe compared to other parts of the world, we're talking about 1/3 of the tuition fees at university level, with the same quality of education. So the third reason is education. The fourth one, in terms of Portugal, is English is widely spoken. Percentage-wise, is much widely spoken that most of the European countries, most of the non-English speaking European countries. So that's very attractive. Of course, taxes, number 5, is Portugal has a special tax regime for people who are coming to Portugal to reside, of a maximum tax rate of 20%. So that makes it very attractive. And the last one is what I call the international appraisal. The different rankings where Portugal has been on the top tier, for instance, has been named as the preferred expat destination in the world. It's also been named as the preferred by Forbes as the preferred destination after COVID. Condé Nast has named both Lisbon and Porto as the preferred tourist destination. And this one, which is very interesting, which was a result of a report from the International Tourist Organization, which basically said that in the coming decades, places like Portugal that did not have the international connections that other European cities or European countries had, namely with North America and with Asia, it's going to be a name changer. We're already seeing not only obviously the Emirates of this world, but we're already seeing the Singapore Airlines, the Cathay Pacifics, even some Chinese airlines coming into Portugal. So that's going to be a game changer in terms of the Portugal growing and investments that under the current programs, which are mainly in the touristic area, will profit from this situation.
Okay, so 6 key positives there for Portugal. What do you see as the benefits and the strategy of the preferred type of real estate immigration investments in light of those 6 strengths? And more to the point, what is the economic value that it brings to Portugal?
Yes, actually, one of the key reasons of these programs, when they are designed by the government, and whatever changes come during the time with these programs, is the economic value. And we've seen that with the US, we've seen that with Canada, we're now seeing that in Europe. This constantly review of these programs, and the number 1 criteria is the economic value. In the case of Portugal, today, the number 1 category of investment is rehabilitation. And Portugal, because of the historic urban and rural real estate that exists, that's why the government has set rehabilitation as a top priority. And it happens to be the number 1 category in terms of golden visa. And in addition to rehabilitation, then we talk about touristic infrastructure. As I mentioned before, the demand for touristic infrastructure all across Portugal is the number 1 driver of investments of golden visa. Of course, this has been a game changer since Portugal changed the program, and residential in Porto and Lisbon are not part of the program any longer. So the government focused on those areas like investment in tourist infrastructure that provide value to the country. And this goes hand in hand with the job creation. So creating infrastructure. Today, the number of jobs that are created by investments on the golden visa are twice what used to be with the residential investments. So that's why going forward, any review that the programs might have in the case of Portugal, those categories that are now at the top, which is rehabilitation, which is investment in tourist infrastructure, will remain in the years to come. If there are any adjustments, could be by 2024, probably in the amount to be invested, whether it's an increase by 2024 from 350,000 euros to 400, or from 280,000 euros to 350.
Okay, so Thomas, let's close this out by, well, really you explaining to me why the combination of investment migration with an attractive property investment makes for a compelling proposition. What is it that stands out from your perspective?
Oh, thank you, Juliet, and great question, and a good one to probably wrap up on. But it really has proven to be a compelling combination, and there's a lot of data out there to support that. And I think that investing in a real estate linked migration program, it's more than just buying a property. You know, investors are always considering and looking at asset allocation and diversification. And whilst real estate has probably and most likely formed a large part of their diversification, I think that when it's linked to an alternative residency or a citizenship at the same time, it really does prove to be very, very attractive, and especially when one considers the other investment options that are available to them. So from a financial perspective, we know that the benefits of investing in real estate can be, and typically are, the increase in value of the underlying assets, so the capital appreciation, as well as the rental returns or the yield that investment brings them. But there's also the intangible benefits and the emotional attachment of owning a property. And perhaps that's even more prevalent when one thinks that an investor or a client is getting residency or citizenship in a new country, and suddenly they have a beautiful home or an investment property or a strong connection and nexus to that country that the real estate investment brings with them. But when the real estate investment on its own is beneficial, but then when it's linked to the additional benefits that the residency or the citizenship gives them, which could be increase in mobility and global access, or it could be improved security or healthcare or a hedge against political and economic instability, then it really does prove to be a very, very compelling proposition. And I suppose to sort of surmise, one would say that historically real estate has proven to be a very smart decision, but combining it with an investment migration opportunity could be an even smarter decision.
Thank you so much. And sadly, there we have to leave it. But thank you all for your time and, of course, your valuable contribution to this session of Henley and Partners' 16th Annual Global Citizenship Conference, in which we unpacked the key benefits of investment migration programs to both investors and to sovereign states. And also a big thank you as well to our online audience. We appreciate your engagement and your interest.